So once again, welcome everyone to tonight's in-person session. Right, thanks for joining us on this lovely evening. For those of you who are joining us online, we do welcome you as well. And tonight will be a very, very interesting evening. So let me just introduce a little bit about today's session. It will be a 2023 market outlook, insights and strategies. Right, so just a brief introduction of our three handsome gentlemen sitting over here. So first up, Ritesh. I'm sure he's a very familiar face with all of us here. So he leads the advisory team here at Syfe, and he also leads the investment team. So formerly, he was a private wealth advisor at Goldman Sachs. Right. Next up, we have Christian. So Christian is actually the head of iShares Distribution Asia. Right. So he actually oversees distribution strategy and execution for iShares ETFs to Asia client base as well. Right. And then on the next one, we have Giri. So Giri is actually an investment strategist, right, at Blackrock iShares business itself. So he has a decade's experience spanning macroeconomics, finance, and international relations. So prior to joining Blackrock, he actually was a partner and investment manager at a multi-family office. So without further ado, let me just pass it over to Ritesh. Let's give a round of applause to Ritesh.
Hi everyone, very excited to be here. Good to see a lot of you joining in person, and there are a lot of people who are joining online as well. So today's session, first of all, let me just quickly do an introduction to Syfe. So Syfe is an MAS and SFC licensed digital investment platform, and our endeavor is to revolutionize the wealth management experience for our clients. Our mission really is to empower people to build their wealth and to have a better future. In terms of the platform itself, we enable it through giving a one-stop solution for all your investing and savings needs. In terms of our journey so far, we are lucky to have strategic backers for our platform with raising over $50 million to date of venture funding. In terms of our story so far, it's really been a story of innovation. We have launched multiple solutions for our clients. We have expanded into multiple geographies, and we have also won multiple awards through, the times. In terms of today's session, let me just quickly do a snapshot of what's happened in terms of the backdrop, right? So 2022, of course, was a brutal year, and we saw double-digit declines in both the equity and the bond markets. This was against a backdrop of decades-high inflation, an aggressive Fed rate hiking cycle, and energy shocks around the world. Coming into 2023, we do see there is more positivity with investors. We are seeing 2 months of inflation data coming in below expectations. So that's kind of brightened hopes for the investors as we kind of move forward. In terms of the stock markets, we have seen S&P 500, on a January month being up close to 5%, and then NASDAQ up close to 8% for January 2. Now, of course, the big question and something that is top on mind for every investor is this rebound going to persist, or will a more hawkish Fed derail this rebound and will lead to the global economy into a deep recession? So with that, I'll hand it over to Giri to take us through the market outlook from a BlackRock's perspective.
Thanks very much, Ritesh. Good evening, everyone. Pleasure to be here. I'd like to take you through. Now, we will get to the US equity markets outlook probably in the Q&A, but I'll save the best for last, right? In this presentation on the outlook, what I'd like to do is talk to you about two of the major macro drivers that we see moving equity markets in the year ahead. The first is the Federal Reserve, and the second is China reopening, right? I'm going to spend quite a lot of time talking about the Federal Reserve and the outlook on the US economy. And I'm going to do that in 3 stages. One is pricing the damage, right? At BlackRock, we're going to talk about how supply side factors have been affecting the inflationary outlook as well as the economic outlook, and what the Federal Reserve is trying to do about that. The second theme is rethinking bonds, where we want to highlight that yields are incredibly attractive right now, particularly in the investment grade credit space. And then the third theme in relation to the United States is living with inflation. So we argue that we are going to see above 2% inflation as a persistent feature of the years ahead, reinforced by long-term secular trends such as aging workforces, geopolitical fragmentation, deglobalization, and the energy transition. And in this section of the presentation, it all sounds like bad news, but I want to highlight 3 investment recommendations for long-term investors to consider as a result of that higher inflationary trend. So there are opportunities in higher inflation, and I'd like to highlight that in this section of the presentation. So that's what I'm going to cover on the US. In the last section of my presentation, I'm going to turn my attention to China reopening, and before we segue to the question and answer. So with that, let's get started with pricing the damage and the role of the US supply side. Now, to understand what's going on in the US economy, I'd like to draw an analogy, right, between the US economy and actually a balloon, right? The US economy might be thought of as a balloon which has a certain optimal size, right? The optimal size is determined by the supply side of the economy, by such things as the working age population, how that is growing, how much immigration there is, how productive workers are in the economy, and the level of business investment. Other elements that determine overall supply are supply chain efficiency, both domestic and international, as well as other factors such as energy and raw materials costs, and the legal and regulatory environment in the country which affects the conduct of business. All of these elements determine the maximum productive capacity of the economy, and that determines the optimal size of the balloon, right? So you might think of that as the surface of that balloon as the orange line, the vertical yellow line, let's say. Now, if the level of demand in the economy exceeds the level of supply, then the balloon overinflates, right? And we have inflation, right? This is what might be called an overheating economic paradigm, and that's what we've seen in the United States over the past 18 months, right? So in fact, what's happened is not just supply is static and demand is overshooting it, but demand increased, but supply shrunk during the pandemic because of various pandemic-induced supply distractions. And that's what you see there, right? The yellow line shifting in to the green line. Right? The supply potential of the economy has shifted inwards. So that's why we say at Blackrock that we are in a world that is shaped by supply, and there are 3 main ways in which the supply factors are leading to higher inflation. The first is global supply chains disruptions have caused higher goods prices all over the world, including the United States. Second, the pandemic has caused the number of working-age people participating in the US economy to decline and remain suppressed to the present day. So baby boomers, for example, have been retiring at faster rates than expected, but the level of immigration has not kept up amidst an uptick in nativist sentiment, political sentiment in the United States. This is translating into tighter labor markets and stubbornly high wage inflation, contributing to higher services inflation overall. The third factor is inadequate housing supply. Pandemic disruptions in the supply of timber, other raw materials, and construction workers is keeping rents and house prices higher than they otherwise would be, leading to higher shelter inflation, which is almost half of all services inflation overall. So if you take just these 3 sources of inflation, goods, wages, and shelter, that probably explains something like 3/4 of the overall inflation figure for core CPI inflation. So excluding energy and food, core inflation is being driven by goods, wages, and shelter. Right? So to summarize, these factors have caused the optimal size of the balloon of the US economy to shrink, even though demand has remained at elevated levels. Now, this of course creates a problem for the Federal Reserve, whose job it is to keep demand and supply in balance. In other words, it's got to get the balloon back to its optimal size. Now, the most painless way this could occur is, of course, expand the supply side, right? Get the balloon to reinflate. But the trouble is this takes time, and the Federal Reserve doesn't really control the private sector decisions and demographic picture that affects the supply outlook. What it does control is demand, which is trying to crush by just the right amount by raising interest rates by just the right amount, as you can see on the left-hand side graphic here. The idea is to disinflate the balloon to the appropriate level without causing so much demand destruction as to cause the balloon to collapse below its optimal size, which risks producing a deep recession accompanied by a large spike in unemployment. This would of course solve the inflation problem, but at a very high cost to people's lives. Now, as you can see in the figure on the left, despite not wanting to over-tighten, The 425 basis points in rate hikes last year was the steepest pace of rate hikes in 42 years, since 1980. And this has produced a doubling in the yield available on US government bonds. Now that's the orange line, the top line for most of that graph there. You can see that it goes from under 2% yields in November a year ago to above 4% in October last year. The net effect of all this is we have much higher interest rates than we have had over the past 15 years, which leads to the second theme in my presentation today, rethinking bonds, particularly investment grade fixed income. We at Blackrock think that investment grade bonds are incredibly cheap right now. These are bonds of high quality companies which are trading at much higher yields and much lower prices than any time in the past 15 years, since going back to the great financial crisis in 2008. This is our highest conviction idea to be implemented immediately. Now is the time. So if there's one takeaway from this presentation that you remember, it is the recommendation of going long US investment grade credit right now. More broadly in the fixed income universe, we also like short-term US government bonds, as well as agency mortgage-backed securities. Finally, because our view is that inflation is going to persist for longer, and you can see here on the left-hand side, the red line reflecting the path of actual inflation. The gray lines show what economists think the outlook of inflation was going to be at each of those moments, and you can see that they've been perpetually getting it wrong, and the optimal path, or the expected path for inflation is getting more and more, Goldilocks, more and more aggressive by economists. And we think that actually realized inflation is going to be higher than the market expects, and therefore our final recommendation in the fixed income space is to go long Treasury inflation protected securities, or TIPS. Right? Which brings me then to the third US investment theme in my presentation today, which is living with inflation. So we think that inflation is currently high, and it will take an extended period to subside. But because of a number of megatrends, it's going to remain high for an extended period of time. And as I said earlier, these are things like aging workforces, geopolitical fragmentation, deglobalization, and the energy transition. But as I alluded to earlier, these megatrends are also going to create certain opportunities, particularly in the equity space. So I'd like to spend some time now on 5 recommendations worth thinking about for long-term investors. And let me just skip ahead here to number 16. Look at the graph on the left-hand side. It shows the demographic picture for China, which is the orange line, that's sort of a hump in the middle, Japan on the left, pink, and India in green. So compare the figure for China around 2020, right? It's the middle of the hump. It shows China's share of working age population. And compare that to the figure on the left in pink for Japan, right? Which shows Japan's working age population around 1990. So compare 1990 for Japan with 2020 for China. And what you can see that from the late 2020s onwards, so just in about 5 years' time, China's working age population is going to start falling at a similar, if not faster rate, than the Japanese population did over the past 30 years. This is why China's leadership is so determined to move up the technological value chain, because unless they raise productivity in China, there is a risk that China grows old before it grows rich. So while there is absolutely an interesting tactical opportunity right now with China reopening, the Blackrock Investment Institute is still neutral on China over a strategic multi-year horizon, right, cautioning that with the potential for structurally lower growth in China over the longer term and a higher geopolitical risk premium associated with China equities, by all means be long China, but do not overweight it unduly in portfolios. So that's the first investment recommendation that is demographic related. The second element that I'd like to talk about is the emerging market opportunity that arises out of deglobalization and the energy transition. Now, deglobalization is likely to be an entrenched feature of the global outlook for the foreseeable future, and we should expect, therefore, a geographical realignment of manufacturing capability away from North Asia and potentially nearshored to countries such as Mexico, or friendshored perhaps to countries like India and maybe parts of Southeast Asia. In respect of India, if you look at the green line there, it shows that the demographic profile in India is much more healthy. In fact, India is the only large economy left in the world that has a fast-growing working age population projected over the next 20 to 30 years. So emerging market exposure to places like Mexico, India, and Southeast Asia appear to make sense for long-term investors. Speaking of emerging markets, I think an underappreciated fact of the world economy right now, and an underappreciated potential beneficiary of geopolitical fracturing and the energy transition, is paradoxically the Gulf. As countries in that region start to open their economies up and attempt to liberalize their societies, albeit from a low base, in preparation for a post-fossil fuel world. Not only are these countries beneficiaries from structurally higher energy prices that we may see over the next decade, but we've already seen how geopolitical fragmentation has brought an influx of Russian business to the United Arab Emirates, and the World Cup in Qatar would have catalyzed greater business interest in the region. Of course, the big news is Saudi Arabia's Vision 2030 project, which involves the construction of probably 900, maybe $1 trillion of infrastructure over the next 10 years, including the creation of entire new cities in places like the Red Sea project or NEOM, where, by the way, in 2029 it's going to host the Asian Winter Games, right? So, given that the incumbent position that Indian and South Korean corporates in the construction space have in Saudi Arabia, and the ever closer ties that Saudi Arabia has with its largest trading partner, China, we could see the benefits that may flow from this development supercycle that Saudi Arabia may be at the cusp of, may flow to the global south, to emerging market equities in particular, bolstering the case for their inclusion in portfolios. The last element around emerging markets that is interesting also relates to social reforms in Saudi Arabia, where the participation of women in the labor force has doubled in just 3 years to about 1/3 of the entire female working age population. Now, there is, of course, a long way to go in the emancipation of the female population of that country, but we should expect over time that this will add a new structural source of demand to GDP there. A third recommendation for the long term relates to deglobalization and robotics. As we move away from just-in-time supply chains to just-in-case ones, it is possible that we may see a record number of jobs reshored back to the United States. But as I said earlier, we already have tight labor markets in the United States, which is changing the balance of power between labor and capital in that country, with wages for the bottom 2 quintiles of the US population and workforce growing at the fastest pace at the moment. So at the same time as labor costs are rising, robotics prices are declining, as new business models ease the cost of adoption. A good example is robotics as a service, where employers subscribe to robotic services in similar ways to how they now use cloud and software services. We think at Blackrock that there are considerable opportunities for robots to be deployed in logistics and warehouses, as well as manufacturing, healthcare, and other service industries. The fourth recommendation relating to geopolitical fragmentation is in cybersecurity. Increased US, China, Russia strategic competition is likely to increase the incidence of cyber attacks worldwide. We are already up 81% in terms of cyber attacks relative to pre-pandemic levels, and governments in the US and EU are already ramping up their regulatory requirements in terms of corporate cyber hygiene and resilience. So we believe and we expect that cybersecurity will move from a niche requirement from corporates to an absolute necessity, and cyber SaaS contracts, or cyber software as service contracts, to be extended and enhanced, and to be insulated from potential corporate discretionary budget cuts if we do have a recession ahead. Finally, back to aging demographics, now in the West, which is creating opportunities to position in the healthcare sector. Not only does this take advantage of a long-term secular tailwind, but demand for healthcare products is pretty inelastic, making healthcare profits less sensitive to macro headwinds. They also demonstrate defensive qualities in an environment of elevated equity market volatility in the years ahead that could prove quite useful. So, amid all the bad news in markets over the past year, we've got 5 pretty interesting equity opportunities for long-term investors that are relatively cheap at the moment and worthy of consideration. So that brings us to my close on living with inflation, and let me now turn in the last segment to China reopening. Clearly, China's equity markets, it's in the news, have been rallying at a tear since the lows of last October. Right, the Hang Seng Index up 50%, Hang Seng Tech up 65%, and all of these numbers are still down some 30 to 45% from their peaks. We think there is still momentum in this trade, particularly for onshore A-shares. Right? As you can see in this graph here, the orange line is the national savings rate in China, and you can see that in the pandemic period, savings have really rocketed from about 20% to above 27%. At the same time, consumption in China has just fallen off a cliff during COVID and has not really recovered. Right? So we expect that the reopening dynamic to unleash these pent-up savings, creating a snapback in Chinese aggregate demand and consumption. We expect consumption to grow at about 9% this year, and for overall Chinese GDP growth to grow at about 6% this year. And as this occurs, this positive economic momentum is not just buoying the Chinese and Hong Kong equity markets, it's also buoying European equities, where we've seen European luxury goods rally, as well as the tourism sector in the past few months. Higher commodity prices, supported by Chinese reopening, is likely also to benefit emerging market producers, while the outflow of Chinese tourists, for example, will benefit Southeast Asia. On the left here, you can see the countries which are most exposed to Chinese tourism, so we can expect the economies of Thailand, Japan, Taiwan, and Southeast Asia to benefit from the reopening as well. So we would recommend positioning in all of these countries to gain exposure to that theme. Indeed, it may not be an exaggeration to say that China's reopening may well have saved large parts of the global economy from recessionary pressures this year. So on that positive note, let me end my presentation. That is the Global Outlook 2023. Thank you for your time and attention. Look forward to your questions.
Thanks, Giri. That was really insightful, and thanks for sharing all the specific recommendations as well. I think we'll reflect on some of these, in the next part of our conversation through, this fireside chat. And in that regard, we'll move over to some Q&A. All right. So let's start with the first one, right? And I'll, maybe bring Christian into the conversation as well. So obviously, as we shared earlier, 2022 was a bit brutal, but in terms of both stocks and bonds, inflation, rising rates, energy shocks, so we saw double-digit declines. But on the other hand, when you look at the flows seem to be still pretty strong in both the equity and the bond markets. So if you could share a little bit about how the flows have been and what do you foresee in the coming year as well?
Sure. Thanks, Ritesh. Good evening, everyone. Really nice to be here and to speak to you. So both of us, we work for the iShares division within Blackrock. And what that means is we're representing the ETF part of the business, which is a very large part of the business. The global assets under management for the ETF part is over $3 trillion US, so about 30% of BlackRock's total assets. I'll caveat that number is before the markets corrected aggressively, but the 30% still stands. So ETFs have grown enormously over the past decade. They're about 30 years old, a little bit more. Equity ETFs, fixed income ETFs, a little bit less, 20. And we have seen all types of investors get involved with ETFs, whether that's retail investors such as yourselves, all the way up to central banks using ETFs tactically or strategically, many use cases. But the point I'm trying to make is that really any investor type is using ETFs today, but it doesn't mean every investor is using an ETF. And Ritesh, to your point, last year, it was the second best inflow year for ETFs. And why is this important? I mean, ETFs are often, classified as maybe sort of a leading indicator for sentiment. And I would just, caution that while ETF flows definitely show what the market is doing, Sometimes people like to think of ETF flows as the fast money because ETFs trade on exchange. They're very accessible compared to other instruments like mutual funds. Therefore, it is easier, more accessible to execute a trade, especially in a difficult market. But again, the ETF is backward looking. So having said that, 2022, second best year for the industry, so not just for BlackRock, but for the whole industry. And I think a lot still has to do with the adoption rate of ETFs. But let's put that aside. ETFs are being adopted. Most of the flow came into fixed income last year, and it changed very quickly after the Russia-Ukraine conflict, where equities had been leading, and very quickly a lot of institutional investors, and then later I think retail followed a little bit, was to downsize your risk, get out of equity markets. And later, when bond yields started to rise, we saw an enormous amount of inflows coming into fixed income ETFs. Not sure how many of you are familiar with fixed income ETFs, but it's the fastest growing part of the ETF complex at the moment, as many investors transition from buying bonds individually to buying bonds as a portfolio. And there's many reasons for that, and we're going to be here afterwards if you're interested in that. But so again, a lot of flows coming into both equities and fixed income. Again, most of that driven by just a general adoption. So again, I'll take an example of fixed income in general. 400 billion out of mutual fund structures and about 200 billion into the fixed income ETFs. The point I'm trying to make here is that there is an adoption piece at play. Looking ahead, and if we look at more recent flows for January, again, most flows that we are seeing are coming into fixed income. I think just with the mere fact that bond yields are where they are now, having aggressively risen on the back of the central bank tightening, fixed income now offers income, whereas a year ago, 2 years ago, you couldn't really say that. So you have income, right? There's also a debate that's publicly being played out at the moment where you look at the yield curves and you look at the inversion of those and you say, well, what's going on there? Is that really, that's a great, the Treasury yield curve often gets used as a predictor of recessions. Some people are saying, well, actually, pension funds are aggressively buying long-dated bonds. They're locking in these high yields now, which we haven't seen for a long time. So, again, I know that was a long answer, but, what's going to happen? Well, we don't predict the future. I think we try and synthesize what we see and make sense of, the complexities of the world. But if you take the investor sentiment at the moment compared to last year, it is certainly more optimistic. I would say cautiously optimistic. On the equity side, we're seeing a lot of inflows into emerging market equities, not very much into developed market equity. And as I said, a lot of flows into fixed income.
Great. Giri, anything from your side? All right, let's move on to the next question. I think that will be very interesting to get views from both of you, actually. So obviously, like 60-40 portfolio is something that has been like a bedrock for investments and for investors around the world as a base. Now, 2022 changed that game a bit because equities and bonds fell in tandem. The correlation aspect that was supposed to play out did not happen. And that left investors in a bit of a disarray. Now, coming into 2022, there is a bit of a 2023, there is this question that does the 60-40 paradigm still hold, or, what do we think about it in terms of looking forward? I think you guys shared a lot about both from a flow perspective as well as from a valuation standpoint, how fixed income looks for the years ahead. But for a typical investor looking for long-term investing, and they're trying to create these portfolios with certain allocations, what does it mean for a 60-40 portfolio going forward? As well as, I guess, is there signs of risk-taking emerging within the fixed income space as yields become highly attractive? So I think, again, from a flows perspective, we covered some of those, but it'll be interesting to get your viewpoints on both of these.
So maybe I can start, and I'm by no means a macroeconomist, so I'll pass that on to Giri. But I think what we would say, investing should be about long-termism. And so if you look at last year, and indeed it was a terrible year for the 60-40 portfolio, right, where you had double-digit downturn in both equities and fixed income, and we haven't seen that for a very long time. But again, should you be basing your investment practices on 1 year? Probably not. And if you look at the statistics, then the 60-40 portfolio has held up quite well. So if you look at, the data from 1980 till today, 42 years of data, 35 years of that have been positive, right? And if you look back similar time period, that portfolio will have averaged you, strong single-digit returns. So is it dead? That's a strong statement. Is it under pressure at the moment? Probably, and there's some reasons when you deconstruct that, and how inflation plays into all of that with the bond side. That's really important. But again, if you look at a longer time period, then it would be a very hard argument to make to say that the 60-40 portfolio is dead. And even though we are seeing, some structural changes at the moment, I think the sort of, average or wider spread sentiment is that no, it's not dead, but is it under pressure at the moment? Maybe yes, but I'll pass to Giri.
Thanks, Christian. It's a bit of a case of the 60-40 is dead, long live the 60-40. I think the view that we've got is that the really interesting piece is, why do you want 60-40? Because when you have a recession, equities fall, but bond prices go up because the Federal Reserve cuts interest rates. Now, at Blackrock, we think that the Federal Reserve will not cut interest rates as we head into a recession later this year or next year. And so that is going to create pressure because equities will fall, and when the Fed doesn't cut interest rates, then bond prices will not rally, right? And so, therefore, we think that, yes, last year was a terrible year for the 60-40 portfolio. I think it was the worst year. I think the data shows it's the worst year since 1937 in the Great Depression. We think that those trends will not go away immediately because of the reasons I've just suggested. The interesting piece is around what is the role of fixed income in that 60-40 portfolio, and I would argue that that role is changing. You don't have fixed income in your 60-40 portfolio at the moment because it gives you diversification. You have it because it gives you yield, right? So you're trading off lower diversification benefit for higher yield upside, right? And so as long-term investors, you collect that higher yield, it gives you a higher total return, right? And you accept that higher level of volatility that comes concomitant with that uptick, right? So, and our view at Blackrock, I think it's worth saying that what we think, at the moment, the market is pricing in Federal Reserve rate cuts later this year. But we believe the Fed, that they're going to keep rates higher for longer, exactly as they say. And when the penny drops for the market, that is what is actually going to occur. We expect fixed income, particularly treasuries, to sell off in the later part of this year. So you've got quite a lot of selling pressure for treasuries, not just from what I've just said, but also from the fact that you've got the Federal Reserve now doing quantitative tightening, right? You have higher government budget deficits across the Western world, all of which suggests that investors will start pricing in a higher term premium, particularly for longer dated treasuries, right? The final point to think about is that we're having the unwinding of yield curve control in Japan. So bonds in Japan are going to start yielding something where they were yielding nothing or negative for quite a long time. And when that happens, Japanese investors, who are quite large buyers of US treasuries, may switch, right, to buy Japanese government bonds, right? And that creates additional selling pressure, or at least takes away an important source of demand for treasuries. So I think the role of fixed income in 60-40 is definitely changing, and we've got to think about it a bit differently.
Thanks, Giri. I think that's very interesting. I think even for investors, what I've observed is previously, for getting a nominal sort of a return, it was very hard for people to generate returns when it comes to fixed income. So pretty much a lot of investors were loaded up on equity allocations through the last decade. Now coming into this year, potentially you can generate a particular nominal amount of return with still a much better allocation towards equity and bond, which was previously not possible. So you can take a more moderate kind of a risk profile, but you're able to generate a much better kind of a return with that because of the increased yields and stuff like that. So that's very interesting in terms of like, how the market is panning out. And that's, one of the reasons why a 60-40 portfolio is not dead in, our regard. Though I guess like, there is always the case of diversification. And Giri, as you mentioned, there are plenty of ways for you to be able to do that through inflation protected securities, through emerging market exposures, through other alternative instruments and all as well. So those are things we can talk about later on too. But moving on, I think the one big thing that everyone is worried about right now is recession. And are we gonna have a recession? And if we are, then how deep is that recession gonna be? Because there are signals in the market which suggest that there is going to be recession as the Fed continues on the tightening process. But I think it'll be interesting to hear your views in terms of all the leading indicators, what they are saying, and then based on that, what your forecast in terms of recession is as well.
Since this is the macro question, I think I will start. Dibs. So on whether we have a recession or not, and on activity data in particular, I'd like to go back to the balloon analogy, because as the balloon disinflates, frankly, we should be seeing activity data fall off. It's actually kind of good news because it shows the economy is cooling and supply and demand are getting back into balance, right? What really matters is the pace, right? We want to see a gradual pace of economic deceleration, because if it's too precipitous, then the market will sell off, right? Because they fear that the balloon is going to sort of rapidly shrink. Right? So the pace really matters. So then we get to the question of how deep is any recession going to be if we get one? And again, it all depends on the pace of economic deceleration, the pace of inflation declines, and Federal Reserve policy. Right? So we all say that the Federal Reserve is being hawkish because they're going to remain higher for longer. Right? But in truth, a truly hawkish central bank would say we are going to raise interest rates all the way until we see the whites of the eyes of inflation, and we see inflation going down aggressively, right? We're not going to care about the labor market. And it's when we see all of that demand destruction occurring, then we'll hike to a peak, and then we'll bring interest rates down. That's what a truly hawkish central bank would do. Instead, what the Fed have done is say, we're going to be higher for longer. We're going to hike to a certain level, and we're going to plateau at that higher level, right? And wait, right? This suggests to me that they're trying to do things gradually. They don't want a huge spike in unemployment, right? They want to bring the balloon back down. They want to keep demand decelerating, but not precipitously declining by crushing the economy too much. And therefore, I think as a matter of Federal Reserve policy, they're going to try to err on the side of a soft or softish landing, right? But ultimately, the question of whether or not we get a recession in the United States depends on the US labor market. And there's some really interesting sort of trends here. So the US labor market really matters because when people have jobs, they consume, essentially. And consumption is something like 60 to 70% of entire US GDP, right? So the outlook of the labor market really matters. So let's just think about some of these numbers, because there's some interesting trends going on here. Prior to the pandemic, between 2017 and 2019, the absolute level of unemployed people, so the absolute number of unemployed people in the United States was about 6.5 million on average. The average number of job vacancies or job openings in the US economy in that same time period was between 6 and 7 million, so more or less in balance. There were about as many jobs available in the US economy as there were unemployed people, right? What happened post-pandemic, right? During the pandemic, unemployment went up to 23 million, so even more than the 15 million we saw during the great financial crisis, right? But it very rapidly came back down, and by July of last year, it was below 6 million, so below trend in terms of the absolute number of people unemployed. At the same time, you saw job vacancies go through the roof, right? Pre-pandemic, but let's say about 6.5 million. Post-pandemic, it peaked at almost 12 million jobs available in the US economy. So there were almost a double the amount of jobs available as there were unemployed workers, right? So what could happen from here, right? Clearly, as the Federal Reserve raises interest rates, economic activity decelerates, some of those job openings will get cancelled, companies will cancel their hiring plans. Some people will be made redundant, right? But here's the question. With so many job vacancies available, maybe what happens is the people who get newly unemployed are able to take up some of those existing job vacancies simply because there's so many of them. So what you could see going forward, right, is the unemployment rate remaining pretty low. All you'll see is just the job vacancies coming down, right? Now, we don't know if this is going to happen, right? It depends on various things like match efficiency and where those jobs are, whether people can move and take them and so on. But we're living in an unusual post-pandemic environment where human behavior has been changed during the pandemic and it may be unwinding back. So the outlook, nobody knows the answer to this question. At BlackRock, we think the Fed will over-tighten and cause a recession because that's sort of the historical norm if you look back long enough, right? It's quite difficult to engineer a soft landing. And so based on that alone, probably we will, but we're in an unusual environment. No one can say for sure. So I'll leave it at that.
Christian, any inputs on that? Or we'll move to the next question? Sure. All right. Awesome. So let's move on to the next question, which is coming back to China, right? Like, the relaxation of the zero COVID policy has been taken very positively by the markets. And we've seen, more than 50% upside in the China MSCI China index, right? From 31st of October 2022 to 19th of January of this year. Even the renminbi has appreciated by above 7% against the US dollar in the same period. So is this like a turn on the corner for Chinese equity and start of the next bull run? I think we covered some of it during your session, Giri, but also from a flows perspective and all, it'll be interesting to cover how we are seeing those trends coming into China.
I mean, from a flow perspective, we're seeing definitely this sentiment of China reopening playing out. So when we look at, again, I'm just looking at the data that we have on our own ETFs, the ones that are based, domiciled around, here and in the US, but relate back to China exposures, it's massively an inflow. So sentiment is there. I think, again, in general, and you always have to break down who are the investors. Obviously, we know that the retail investors can move faster. Institutional investors take time to make decisions. You have investment committees and, a longer decision-making tree. But what we're seeing, driven by retail primarily, is a lot of inflow into just broad, diversified China equities, and also more thematic. Tech is back, at least for now. And so whether that persists, it remains to be seen. But certainly, you have the reopening. With that, you have consumer demand. You also have, neighboring countries benefiting from that. Travel, right? Just, hotels filling up again, people spending money. And I think with any reopening, people want to have fun again. And so they spend money when they want to have fun. And we're seeing that play out. And again, the sentiment has shifted. It'll depend on many factors going forward. And, I think, sort of, not to and we'll keep it in this room, but there also seems to be a softer tone in the relations between the US and China at the moment at a diplomatic level. Again, geopolitical risks always exist, but we'll see. But the flows right now point to people being quite optimistic on China in the short term.
Nothing much to add beyond what I've said earlier, but I'm conscious that at the start I promised that I would give a bit of a US equity markets outlook. So are you happy for me to sort of do that now?
Yeah, absolutely.
Okay, so I think in terms of the US equity markets, that's the $1 trillion question that everyone wants to know, right? Where's the US equity market going to go? And I think a useful way of thinking about that is to think about the distinction between forward earnings and multiples, right? So you can decompose every level of the US index, right, into a product of two numbers, right? What is expected corporate earnings in the year ahead? And then you multiply that by what's called a multiple, a valuation multiple, which tells you how much investors are willing to pay for those forward earnings. Multiples tend to rise when there's great confidence about the future path of corporate earnings and profitability. Multiples also tend to rise when interest rates are very low, because then you can borrow cheaply and put it into the equity market, so people pay more for corporate earnings in the equity space, right? So what's happened over the past year, right? On the 3rd of January, last year, we had an all-time high on the S&P 500. I think it was just under 4,800, right? And that was forward earnings at that point were something like $228 a share. The multiple was really high, 21 times. So you take 228 and you multiply that by 21 and you get 4,800. That's how you get the number, right? Now, you look at the end of the year, right? It had fallen from 4,800 to about 3,800. So we had about a 1,000-point decline over the course of last year, 90% decline in the S&P 500. But forward earnings, right, still are quite high. They were about $230, right? The entirety of that 19% decline was produced by multiples going from 21 times down to 17 times, right? So it's really important looking at the equity market in the year ahead to distinguish between what a multiple's doing and what a forward earnings doing, right? And so in that context, what we could see in the year ahead as we potentially have a recession is that we were likely to see an earnings recession. So corporate earnings and profitability are going to decline. But as the Federal Reserve hikes interest rates and plateaus, the end of that hiking cycle, right, might push multiples up. So you've got that downward pressure from earnings versus the upward pressure from multiples, right? The last element I want to sort of talk about, which is a trend that we're seeing, is that throughout the pandemic, you saw that basically you could almost narrow it down saying that basically one thing moved the market. Federal Reserve, and it moved all equities and a lot of bonds, right? It's Federal Reserve interest rate policy. So from March 2020 to December of 2021, rock bottom interest rates meant that equities generally rallied. The correlation within equities was really high, right? And then from January of last year, we had the opposite effect, January to October, right? Federal Reserve tightening, interest rates up, correlation, high correlation between equities all down, very little dispersion within that, with the sole exception of perhaps the energy sector, right? But from October, what we've been seeing is that's been changing, right? So you're not seeing that same high correlation across all equities. We're seeing, for example, financials starting to rally, because in Q3 earnings last year, we started to see that actually with higher interest rates, net interest margins for banks were going up, so their profitability was rising, so financials have been rising. You have other idiosyncratic elements like the Inflation Reduction Act in the United States, right? That's pushed up construction. That's pushed up things like construction equipment. It's also pushed up elements, I'll sort of have it here, industrials, right? Because of this idea that they're going to see a multi-year build out of US infrastructure, which is going to boost certain economic segments. The resumption in global air travel is underway, but we don't have enough planes around the world. So we're seeing industrial airliners and equipment suppliers also rally. And finally, higher commodity prices is seeing miners rally as well. So we're moving into a world, now it could be that with the Federal Reserve, you know, maybe there's a really lousy inflation number. Inflation looks it's higher, Federal Reserve says it's going to be really hawkish, and then everything will start downtrending together again. But I think we're also moving towards a world where the Federal Reserve is not the only thing moving markets, and we could see this dispersion within sectors, which leads us to this idea that maybe we're going to see a rolling recession, that different sectors of the economy, corporate earnings is going to bottom out at different paces, right? So maybe consumer discretionary first, and then mining is up, and energy is up. So there may not be this moment where you have just corporate earnings just falling across the piece, across the entire economy. It could be a staged process that keeps us sort of range bound in the equity market. So I know that's not a prediction, but I think it's a framework that's useful to, you can take home and think about over the year ahead. And that's sort of why, with this higher dispersion in the market, it's sort of why I try to keep the investment recommendations pretty granular, thematic and sector specific, because I think it's unlikely we're going to see broad beta in the market. We're going to see much more dispersed returns, and so the recommendation is to try to get a bit more granular in positioning.
Yeah, that's a great perspective, Giri. I think this dispersion thing is something that we have also been talking about, and within the sectors, I think things can be very different, and even within sectors, things can be very different. For example, when you look at tech, the big tech and profitable tech versus non-profitable tech, the story was so much different. I mean, both of them fell, but the pace or the amount of fall that we saw in the non-profitable tech was way beyond that you saw in the profitable side. So definitely very interesting times. I think, as we move forward, we will see more of these kind of play out. But these, perspectives are really helpful for investors to, look into 2023 and make more informed decisions. I think with that, we will move over to the next section where I want to open it up to the audience to see if there are any questions from the floor over here. So, I think this is mostly it in terms of what we had to cover, but let's open it up. Please, if any questions, just raise your hand. I think Jason is there to take some questions from the audience.
Sure. Two really interesting questions. Thank you very much for them. Unfortunately, you have stumbled upon my specialist subject with Ukraine, because in a previous life I was a defense economist at an international relations think tank. I very much agree with your view that actually I think the conflict is going to be drawn out, and I don't see an immediate resolution. I think that the provision of armor is very important because the remaining territory that the Russians do hold, they are building defensive positions, and it's going to be very difficult for the Ukrainians to break through that without heavy armor, which is, I think, partly the reason why that is being supplied by Western countries. I think it's also to help them with defense, because I think with defense in depth. So it looks like the Russians are planning a spring offensive. And if that's the case, then if they are successful in breaking through, then armor is very useful to actually close those gaps, right, where they have been able to break through. So overall, I think it's going to be long and drawn out. I think both sides understand that that's going to be the case. And maybe that's the best case scenario, because, you know, either way, if you have a breakthrough for either side, for example, let's say if the Ukrainians break through and head towards Crimea, I think that does increase the probability that you might see some sort of dirty bomb being used by the Russians, right? Which is going to be terrible for everyone concerned. So maybe a broad stasis, right, and a slow sort of bleeding out of this conflict and creating a sort of frozen conflict on the Europe's eastern borders, maybe the best possible world, for all parties concerned. In terms of the European equity market outlook, so European equities have been rallying quite surprisingly over the last couple of months, right? And that's mainly because of the weather. A lot of the fear, for example, in August, September, October of last year, was that they didn't have enough energy reserves to last them for a very cold winter. But they haven't had a cold winter. They've had a very warm winter, which means that actually gas prices, which I think in August were almost $300, are now trading in the $60 range, right? So they've really come off, and that's produced a lot of relief in markets, that we're not going to have a sort of stagflationary environment in Europe and a decline in consumption on the continent. So European equities are rallying, and I think the big question is whether or not for next winter, if we do see a protracted conflict, whether or not Europe can secure the gas supplies required for next winter. But at the moment, things are looking up for Europe. I'll just add to that China reopening is actually very good for Europe as well, because a lot of Chinese tourists this year we can expect traveling to Europe to boost demand there. And also in the luxury goods sector, I think LVMH is like trading at all-time highs. I'm not sure of that, but someone told me that. So the luxury goods sector, on the back of increased Chinese consumption, looks supportive. So I'll leave it at that. Oh, Tesla, yeah. I'm not a Tesla expert, unfortunately. All I'd say is that at the end of the day, Tesla is a car company, right? I'll just keep it as simple as that. It is a car company. It's important to remember that. Now, each of us buy a car. Just because there's a cool new Tesla available doesn't mean we're going to buy two, right? So when Tesla, it may take some market share, but what we know about consumers is that we like variety, right? It's very seldom that you have a monopoly in something in a consumer discretionary space, right? And so, yes, Tesla will take some market share from other major manufacturers, but is it worth like more than, I don't know, GM, Ford combined? I really don't know about that, right? I personally stay away, and I just caution people to remember that actually when something is really hyped up, maybe it's better as a trading position rather than a long-term hold type of view, especially at elevated valuations. Yeah. Okay, so another really interesting question. This sort of falls in the last part of what I was talking about the U.S. equity markets. If I was to stick to the BlackRock Investment Institute view, we're going to see a recession, and therefore, stocks in general are going to decline. That's why we have a neutral outlook or underweight outlook on DM equities. In respect to mega cap, I think there are challenges because, for example, like Google, a lot of that is advertising spend. If you do have a recession, advertisers pull back spending, so there's a problem there. Also, if you think about the regulatory environment that it might face going forward, there's a big DOJ case now, an antitrust case on Google specifically. I kind of stay away from giving a really sort of granular view on a single country specific stock. Sorry, a single name stock, simply because my role is broader than that. So I'd kind of stay away from that. All I'd say is it depends on the trajectory of multiples, right? If markets don't, if let's say we don't have a very deep earnings recession, right? Or even if we have a earnings recession, the market looks through that because it says the Federal Reserve is was topping out the rate cycle, so we have multiple expansion. Well, some of the biggest beneficiaries of multiple expansion will be the mega cap stocks, right? So I just go back to the paradigm I presented earlier. I would say that, okay, the recommendation would be to be opportunistic, right? If there is a sell-off, buy. If you already hold it, be a long-term investor, because and that seems to me to be the most sensible policy on that.
Yeah, and maybe just to add, because we're probably the wrong people to be asking about stock-specific tips. Yeah, and you know, I think overall, what I would just say is that you know, coming again from this sort of index background and a long-term approach, when you invest, the longer you invest, if you take every year and you say, what is the probability that I lose money? That probability is highest in year 1, and then you go to year 2, year 3, and that number keeps decreasing until you hit a certain amount of years, and then it's positive. And that number is 15 years at the moment. Every year, if you've invested for 15 years, you'll be making money. But again, the point is, you know, we do advocate diversification. Is it a get-rich scheme? Probably not. But for you know, long-term investing, certainly, you know, it pays off. Again, you'll have years where correlations are not working the way they used to, right? Where the 60-40 portfolio doesn't work. But the biggest challenge, as we know, it's the timing, right? And anything that you touch, it's all about timing, whether it's sectors, whether it's factors. It's always about the timing. And I think there's, you know, what we do see with investing is that it's so complex. There are so many factors that play into it, right? Fundamentals, but also sentiment and momentum. It really is a complex thing. So again, you know, there are always opportunities, but the safest way to play it is in a long-term diversified fashion.
Thanks, Tristan. I think those were great closing thoughts in terms of, you know, our outlook this year. Thank you so much for coming in and participating and sharing all your views. I would like to invite now Dhruv Arora, our CEO, to share a few words from his side, as well as give a performance update of Syfe.
Thank you so much. Got the clicker. Just change it. Firstly, thank you, everyone. It's great to actually see, and we are very excited to do these in-person events again. It's just a very different feeling. We'll be around for more conversations. Let me first start off by thank you so much, Christian and Giri. I think the views are incredible. Recession, maybe not the favorite word I want to hear, but I think this is what we, as you know, users, as consumers, this is the kind of perspective that we as a business want to offer. We want to give users a view from the leaders in the world, from different counterparties, and then for them to make the right decisions. Now, talking a little bit about views, last year was a very tough year. All of you have been invested. I presume many of you are customers of Syfe. But one thing which was very fascinating was that every month last year, no matter what happened, we were net adding positive assets. Now, this was tricky, especially tricky in the middle of the year when assets started, like prices started going down, etc. But when you fast forward this, and coming back to that beautiful point about, you know, you said timing is important, but as we say, it's more about the time in the market. If you extend this over a duration of time, I think that's when magic starts coming into play. And I don't want this to become a little bit of, you know, yes, we are very good and all. We probably should talk a little bit more about these things, but maybe just a few slides on how, you know, things have been. So the year has started actually quite well for us, and a big reason for that is that we said invested in China. This was a question I think we got from a lot of users. Now, the view was that we never really was like, oh, maybe we should take China or we should do US. We've always built our portfolios with a strategic asset allocation framework. We look at factors and we invest for a very long duration. And while there was a rough phase in the middle of the year, for those that have stayed invested, the numbers speak for themselves, where, as you can see, the performance was actually, you know, even over the last 1 year, which was a tough year, you can see beating, you know, both the MSCI World, which is our benchmark, given it's a diversified world index, as well as, you know, the S&P 500. Now, if I fast forward this, to even see what this could look over a longer duration, some of this is back tested, but at least now, of this 5-year, 3.5 years is actual transactional history. You can see over time, these numbers just keep on improving. These are analyzed numbers, by the way, so very, very powerful in that regard. If you can go on. The same thing with the REITs, right? Was actually a bit disappointing because we all love REITs and they were not performing the way we wanted. But if you think about it, even last year, it was actually down about 9.5% after, a few spectacular years that actually led up into it. Now, what made it really powerful was the fact that when you look at what's happened in the very first month, now if you go back with a roughly 1-year kind of horizon, you will actually see this is profitable in some ways. But what's most important, and this is for those seeking passive income, is the dividend side, which actually should be now closest to, if I'm not mistaken, the multi-year high of nearly 6%. This is a function of higher dividend yields, but more importantly, even decreasing prices in the REITs themselves. And last but not the least, one of our more, I guess, safer conventional offerings is the Cash Plus, which was very popular, I would say maybe a year ago. Currently, the banks are doing probably everything in their, in their availability to actually make FDs attractive and so on and so forth. But I think the beauty of this has been that whenever we've given some sort of projected returns, as you can see from left to right, we've actually ended up with offering much higher net annualized returns, currently clocking at 3.34%. So the idea of this was more to share that we, of course, care about performance, but we don't want to be those guys who says, hey, come to us because, we're always going to beat the benchmark and we're always going to perform. I'll be very honest, if that is what we wanted to do, we would have launched a hedge fund rather than having a business for 40 basis points. But the reality is that when we build these on factors, what we are offering is essentially institutional grade service, institutional grade products, working with providers such as Blackrock, Vanguard, etc., and trying to bring essentially that level and quality to everyone. So thank you so much for joining us today. Thank you so much for staying invested. And even if the year causes recession, it's still year one. And then you can think of 2, 5, and maybe at the 15-year mark, you will know this was never a problem. I want to believe you'll probably know that much earlier if you've been with us from early days. But thank you so much, and please join us for some snacks and drinks. And I look forward to meet each one of you after. Thank you.
Thanks, everyone.